Hello and welcome to The Call. So this is 10 stocks picked by you. We've got an hour and two expert guests here with us in studio. It's a Friday, June the 4th, and just past 12 noon here in Sydney. And we're watching with interest what this local market is doing. Of course, plenty of expectations around that US non-farm payroll report a little bit later today. Now, just as a reminder, we are live now, not just on our live stream, but also on Twitter, on Facebook, and YouTube. If you're just joining us, we do this every day at 12 noon. We talk about 10 stocks in details and try to get some investable ideas out of it for you. We also run our own portfolio, courtesy of our partners at NAB Trade, and we'll detail that about halfway through the program. I'll introduce you to my guests in studio today. Great to have them both in studio. Jun Bei Liu from Tribeca, welcome as usual. Good to see you.
Good to see you. Great to be here.
And Henry Jennings is joining us from Marcus today. Henry,
Good to
feels
be
like
here.
a Friday when you're in. He was in for the last call, if you recall, last week, and the last call broadcasts at 4 p.m. And of course, you can catch up with that via our website or the app. Jun Bei, we've got to get you in for the last call one of these days again.
Absolutely, in the next few weeks. I'm really looking forward to be there.
Good. And I'd like to get your thoughts on where we sit this week in terms of the overall index. Now, those two record finishes for the XJO. I've mentioned that we have this big risk event tonight, but is it your view that we could continue to see this market pushing higher?
Look, if you take a 12-month view, absolutely. Aussie market is looking pretty strong. Even though we're pushing, all-time high, but still we underperform the global indices by quite a big amount. Something like a high single-digit to 10%. So even just to catch up to those markets, so that we will do this much. And at the same time, our dividend, we're a high dividend-paying market, so there's a lot of dividend coming back as well. With banks will increase the dividend payout, and economy is doing okay. Reopening taking place. A little bit of a lockdown in Victoria slowed the pace somewhat, but everything else seems to be on track. Consumer spending, corporates are spending. The housing price is doing well. So all of that together, our market actually is looking pretty strong. But look, tactically, June normally is a month where people do, take some profit, and then there's a tax loss selling. So towards the end of the month, we generally see a bit of rotation. Just selling some of the winners, or even the others. It might be potentially a little bit of weakness, but that's just very tactical. On a longer term view, it's looking pretty strong.
And are any of the retail investors that you engage with looking to take a bit of profit off the top in some names right now, Henry?
I think there's a little bit of, I'm a little bit cautious. I always get a little bit cautious on all-time highs. There's a few big things coming up in the US, and the whole stimulus thing seems to have sort of got bogged down to some extent, and we are entering a period where there's a bit of a lull. The US guys go on holiday, summer driving season, all this sort of stuff. So I'm just a little bit nervous. I'm surprised that we haven't come off today.
Yeah.
Once again, we're seeing the strength in the banks. And what I think is quite interesting is the Victorian lockdown is actually a positive. I know it sounds a bit perverse.
How so?
Not so much positive for Victorians or Melburnians, but it has reminded us collectively as a nation that we cannot afford to be complacent. And as a result, we are all rushing out and getting vaccinated, which before Victoria and Melbourne sort of did that lockdown, then everyone was going, I'll just wait, I won't bother, let's see how it pans out.
Not me. I want to get on a list, yeah.
I think that's really helped the sort of the psyche of people getting nudged out of their complacency, knowing that it could happen anywhere. So that I think is good for the economy long term. The more people that get out there and get vaccinated, get on that list, is better. I mean, the market does look great, but I'm just a little bit, there's just the cynic in me, the kind of the negative person in me just keeps thinking, well, we're seeing such froth in something. I mean, the whole AMC thing in the US is crackers.
Yeah,
I can't get my head around that whole thing, and even here there's the odd frothy stock.
That's right. So that's been incredible. So certain parts of our market certainly look very stretched in terms of valuation. They all actually have come off in the last couple of months. A lot of those growthy and stretched space like tech and or unprofitable businesses sort of valuation they're trading on. But look, if you look across the other parts of the market, they actually don't look that expensive. They look expensive on a 12-month, on 6-month view because earnings still recovering from from the sharp fall last year, so they look a little bit expensive. But if you take a 2-year view, they all actually look okay. Actually look reasonable value. And then considering they're going to grow quite significantly, whether it's resources, whether it's banks and the other consumer cyclicals, our market actually doesn't look too bad, taking out some of those really stretched valuation space.
Because that GDP read we got this week, I mean, fundamentally, if corporates do well when the economy is growing, that was a big endorsement of the story here in Australia. We had quite a bit of company news this week. Wesfarmers was one that sticks out in my mind from yesterday. We're starting to get more guidance coming from these companies. Today we heard from the Reject Shop, and that is our stock of the day. So saying that trading activity continues to be challenging with its stores trading below pre-COVID-19 levels. Full year financial sales expected to be between $776 and $778 million. That's quite a tight range. Also saying that EBITDA will be between $8 and $10 million. So the Reject Shop is stock of the day. Jun Bei, I will turn to you first. I find that interesting, trading well below pre-COVID-19 levels in a recession, which, believe it or not, we did have. Shouldn't the Reject Shop have performed well?
Yeah, look, it's actually quite interesting. Reject Shop should perform as well as the likes of discount department stores, which we've seen Kmart is doing so well, incredibly well. I think, but the challenge for Reject Shop is that quite a lot of earnings made literally in 1 month, 1 or 2 months of the year. And if you don't get your category right, you kind of, your entire financial year can be wiped out, really. So I think, for this business, they've gone through quite a few cycles already, when they don't get the product range right, and then they sort of struggle through the period. So my view is that I think they should be in a much better environment at this point. It is one of those reopening play. However, my view is that there's much better retailers that you can sit in to play that reopening.
What would be an ideal retailer?
Oh, okay. So to play the reopening, Lovisa will be the number one for me to sit in, because many retailers actually benefited a lot from the stimulus and everything else. So they're actually COVID beneficiary, but Lovisa was not. So, I think we talked to you before that it is difficult to buy trinkets online. It's relied upon the store, and it's relied upon the events to take place, the Melbourne Cup, all these events, weddings and things. So when these things started returning, people will go and buy the trinkets. So we're already seeing things actually picking up quite quickly, but this is one stock that earning will drive quite significant growth. And at the same time, they're growing well in the US. They will capture some of those, the stimulus checks. And so it's just well best positioned in the next 12 months.
All right, I put you on the spot there, Jun Bei, but we'll consider that your bonus buy, so you're off the hook for the rest of the program. Reject Shop, though, back to that stock of the day, down by close to 10% today. Remains to be seen where it will end. Yep. A lot of the commentary coming from the company as well is in keeping with what we're getting increasingly focused on, which is supply chain disruptions, which is increased supply chain costs and the like. So is this business in the too hard basket for you right now?
Yes. Way too hard basket, and as Jun Bei says, there's other better retailers out there that got more exposure. These guys did really well during COVID to begin with because they were selling the Hanny Sanny and the cleaning products and all this sort of stuff, but they've really been hit by the supply chain. They're kind of down, they're at the bottom of the supply chain as well. Their products, they're not high-end products, these are everyday things. Shipping costs have gone through the roof. Now a container, a 40-foot container,
high price tags.
No, containers now are $10,000 to get them from Shanghai to wherever. It's extraordinary that it's up 3, 4, 5 times in some cases. So these guys are suffering because of that. I can't see any reason to change that really. I don't know how it's going to change in the short term. The footfall traffic is also a bit of a concern. They haven't got the digital exposure that others have. They haven't got that online exposure that we've seen that has been so successful for other companies and has transformed their businesses. So I really just can't see why you'd be there, to be honest. It is quite a volatile stock as well. It's not the most highly traded stock, so it's one, I think Andrew Willett would say it's Danger Will Robinson.
Yeah, all right. So that is the stock of the day, the Reject Shop. Let's get to the companies that you have written in about. If you would like us to cover a company, you can email us at thecall@ausbiz.com.au. NIB Holdings, NHF, is the first on the list. This is coming from Robert, I'm just going to flip a coin. I'll start with you, Henry. I see you checking your notes. Look, the private healthcare operators have been such an interesting story through COVID. But to your point, we're getting vaccinated. Hopefully, we'll all have our double dose in good time. Yep. What then will that mean for these guys?
Well, I guess return to normality in some respects. They do make quite a big amount of money from international students in the insurance market there, which is obviously, that's not going to come back. So there is a bit of a hole there. The stock's done really well recently, I have to say, as has Medibank Private. Both of them sort of a bit of a post-COVID push. It's not the most exciting stock in the world, but it's a slow kind of growthy, grindy stock. Every year you get, April the 1st, you get that 4%, 5%, 6% rise in your private health insurance. You wonder what you're paying it for. You wonder how much you get when you do things. It is that kind of slow growth stock, not a great yield. But out of the two, I much prefer NIB to Medibank Private. I think that's a better operation. It's more of a niche, and it seems to have a bit more sort of funkiness, if you like.
Funkiness? Well, I didn't know that was something we judge.
Well, you need to be funky. You need to be funky.
To attract the younger cohort?
You need to attract the younger guys, because the younger guys don't get sick, and they support us older people that do get sick. And if you're not funky, and Medibank Private is not funky, then I think, NIB is funkier.
Okay, well, that's a new one to me. But
Sorry.
Jun Bei, NIB Holdings in particular, and then obviously how it compares to others in the space.
Of course. So NIB is a hold for me. It has performed very well. It's more of a funding. You can use it to buy something else, because my view is it's quite fully priced at this point. But you can hold on for a little bit of yield. The reason it performed well is because the hospital claim is still yet to pick up. So even though the hospital's reopened and everything, but there's so much backlog. Some of those claims are yet to be claimed through, and that's why they're earning. They've upgraded their earnings because people are not using. They're paying the premium, but they're not using the hospital service because there's a huge amount of backlog. So the upgraded earnings. But looking forward next 12 months, we know the hospital's open. We know the backlog will be clear through over the next 12 to 18 months, and that will be above trend. So that means earning will go backwards as these things happen, just normalization of that. Now, another reason of why it went up is also because the view of the international, the travel businesses, that potentially could be a reopening play, and for that potentially, but it is a very small part of the business. So all that together, private health insurance certainly is in a better place compared to what it was 12 months ago, because people are more health conscious. They are taking on more private health insurance, and those private health insurance members has been growing 3 quarters in a row now, and that's reversing the trend of last decade, which has been negative. So that is positive for the sector, but it is over the long term. When you actually look at it, you go, okay, that's good for private health insurance, but it's also good for private hospital. So on the other end, I look at Ramsay, and I compare to these names. Ramsay clearly is going to also be a beneficiary of increased private health insurance taken out, and also Ramsay is a complete reopening play where the hospitals will come back online, and a lot of those extra costs that they put in place will go in the next 12 months. And more recently, they used this market weakness opportunity, and they want to buy out their largest private health insurance competitor in the UK, where the market is still quite immature for the private health hospital sector. So my view is that one looks a lot cheaper, and a lot more earnings growth, structural as well as cyclical as well. Much better positioned relative to the other ends.
Okay, so NIB is a hold for you. I missed
Hold.
it's a hold in all that funkiness.
Sorry,
I got
distracted
distracted.
you with the funkiness.
Now, look, just a note for our viewers. They're on the charts today. No point in writing in about it. It's just a technical glitch. We apologize in advance. Santos is the next on the list for Andrew. STO is the ticker code. Look, we are continuing to see oil prices recover. I mean, climbing above that 70 per barrel mark for Brent. That does have an impact on LNG pricing as well. A lot of that, again, comes back to the vaccine rollout, the demand story, production also factors into the mix. These guys have had a really good run this week. But really dependent on those prices going forward. Are you a believer? Are you secure enough in the recovery story to be investing in the oil and gas plays here?
Absolutely. I think, across all the commodities, the oil probably certainly look the best positions to be leveraged to that whole, world return to growth. The main reason being that, jet fuel, people have yet to start traveling internationally in normal volume. So international borders often are still closed and, all of that. So when that returns, the jet fuel demands are the swing factor for oil prices. And we're already seeing the demand for oil increasing and, and certainly that jet fuel is going to make it going higher. Now, on the other hand, the supply side, OPEC and Russia, and they have held back a lot of inventory. When the oil price went to negative, and they are in that slow release sort of state. But more recently, they've spoke to wanting to support a stronger oil price. Then that certainly is very supportive for that market. And oil equity actually hasn't performed as well as if you look at the oil prices. So in my view, they're still very underowned, and I think this one will do very well.
And so that's a buy?
Yeah, that's a buy for me.
Okay, yeah, because if we're talking price, still has not recovered to pre-pandemic levels. So is there value in there?
I think there is. It's interesting. Santos were going, if we had the chart, you'd be able to see it, but I'll draw it. It was going absolutely nowhere for weeks and weeks and weeks, despite the fact the oil price was ticking higher and ticking higher. We're up, 40% or something in Brent crude at the moment this year to date. And Santos was going nowhere until this week. And it was almost as if someone switched the light on and went,
someone woke up.
Someone woke up and said we should buy some oil stocks. And they have gone.
So not too late.
I don't think it's too late, no. And I like the oil story. And I think what OPEC Plus has shown is discipline. They've been very disciplined about how they've conducted themselves, which I've got to say is pretty unknown for OPEC. They usually, they talk discipline and then it's every man for himself. So I think there's still potential in Santos to push higher. They've secured the CEO till 2025, I think it is, which was a bit of a concern because he was potentially off, Kevin Gallagher, potentially off to Woodside, as Peter Coleman is leaving. So I think that's a positive. He's done a really good job. They've still got a bit of debt, but they've got a lot of cash flow coming in. The oil price is supportive.
Is this a buy?
Yeah.
Wow, that's going in
the
portfolio.
We got there, didn't we?
Yeah, we get there in the end. So, okay, that's going in the portfolio. Discipline being seen, still not topping out, even though we've seen this run this week. Good one. We could continue to talk about oil prices, but we'll move on to the next one. To Duke Exploration, DEX. So this is from Lockie saying, just giving us a bit of detail on this company, because I suppose a lot of people have not heard about it, saying it's got a tier 1 potential project with immediate resources development opportunity. Further, 10% of the company is held by Kieran Slee, who's a geotechnical engineer at Oz Minerals. What do the experts think? So, Jun Bei, I'm sure you've done a little bit of research, but it looks as if it's an explorer that's looking at some of those historic sites, which seems to be a bit of a trend, particularly in the gold space, and then copper comes along with that. Just this week, it had some new drilling results at one of its sites, and it looks like it's in a good neighborhood, or so the company says. But it's an explorer.
Yeah, that's essentially my view. I would avoid it. It's too early stage. You want to gain exposure. You buy the producers. You buy the high quality names. So, Oz Minerals is the best asset. Around the world, probably the most expensive copper company around the world too. But it's a high quality management, high quality asset. You can go if you want to go cheaper. You can buy Samphire, which is probably half the valuation, and it's very, very cheap, and get that good exposure to copper. Also, there's a new listing that's coming. Metal 29, 29 metal, So that one will be on similar sort of multiple, I guess, as the Samphire. So so you have a lot of exposure to that sort of space. Just explorer. Usually there's a lot of risk in terms of the outcome and whether there is copper or not.
It's still yet to be proven. But do you like copper as an investment story?
Yeah, I do. I think copper is well positioned. For one is the global recovery. Two is that that whole electric vehicle space and global consumer goods and everything is very much copper, nickel. You need to use them. So I like them. They have had a massive run. Yes. So potentially can have some of the pullback, but this is when you just build more position.
Yeah. Now. you know, we know the investment case for copper.
Yep.
So would you do it via an explorer?
Well, no. Let's face it. I mean, these guys are 5-10 years away from actually producing any copper if they ever do produce copper. So if you know, it's kind of a sentiment thing. You buy copper explorers because the copper price is going up, but the reality is, you know, the ones that are leveraged to the copper price really and truly are the guys who are actually producing it now and can take advantage of this spike in the copper prices. Having said all that, Duke Exploration, which is a $26 million company with $5 million in the kitty, doesn't trade that much for a specky stock. It is a specky stock. Mount Flora looks interesting. You know, we're in that kind of market at the moment where specky stocks, they'll have a good hit and they'll put in the word spectacular or bonanza or massive, which are actually geological terms. They're not just, they make these up. It's not, you know, they're fans of TV shows and they go, we've got a bonanza strike here. These are actual real terms. They put those in and this thing could go nuts. But, you know, there's 25 out there that could do exactly the same thing. So you pick a runner and a rider. It's highly speculative. You know, it's tiny, $26 million. Doesn't trade that much either. So
that's a no and a no for Duke Exploration.
Not for
Sorry,
me.
Lockie. Now, Bubs Australia, I think this is a good one coming from Maya because, of course, it was in the news this week. It was up by 18%, I think it was, on the day that three-child policy was announced in China. It's come back a little bit since then. Do you think that was a bit of an over-exuberant reaction in Bubs? It sounds as if Maya is a owner. She says, should I keep or sell Bubs shares? So should she be selling to lock in some of, hopefully, the profits that she's made?
Look, I think a lot of bad news has been in the price. It's been like A2. So for the share price to jump significantly on the three-child policy is simply because it was too cheap. So now, first on the three-child policy, it sounds great, but it's going to take a very long time. If you look at when they first launched the two-child policy, the population, the birth rate hasn't really increased. So, you know, they are going through, in the next 5-10 years, China is going to go through that aging process in terms of overall population. So that's why they stepped up going, we need 3 kids, but problem is how do you incentivize that? So the government's trying to do a few things like maternity leave and all of that to encourage that, but you know, it's going to take a long time to translate through, and you know, it's more of a blue sky sort of thing for these businesses, and of course, you know, whether your business can have a market share by then to start with is another question. Now with Bub, it's got a very great product, and it is in demand in China as well. You know, a lot of bad news in the share price, and you know, business completely hurt, like A2, because of the Daigou channel was so disrupted. There's no traveling, there's no students. That's not going to return for quite some time. So you know, that is going to be quite challenging. Potentially, it's a takeout target. You know, whether A2 could buy them and just add to the portfolio, I think it looks pretty attractive. But would I be buying it? I think it's too early in terms of, you know, you can't buy something just think it's a takeout target. Just at this point, things are very, you know, quite difficult, but I will hold on to it.
Okay, so if you had it, you would hold on to it.
I will hold on to it.
There you go. Would you hold it if you had Bubs?
I
mean, obviously, we don't know what price you got in at everything else.
I have hated this stock for such a long time. And I do the thing where I walk into the supermarket and I look at I go to the infant formula shelves, and I've got to say my local supermarkets are probably not representative because Northern Beaches is probably not prime hunting spots for Daigous and Asian buyers of this sort of stuff, which has been driving these stuff. So it's not the best, but I still go in and look at the shelves and look who's at eye height and who's down the bottom of the shelves and look for the products, because if you don't recognise the products, and I have yet to find a tin, every now and then in Chemist Warehouse you can find the Bub stuff, and it's just, I don't get it. I really don't get it. It's always gone over my head. I've always struggled with the story. I think at these levels it's probably a bit oversold, but there's no international travel returning from China for a long time. I was even reading this morning that because the way they vaccinated their population, I think they've got 60% vaccinated now, they've almost got herd immunity, but they've vaccinated them with a vaccine that doesn't actually necessarily work, and they haven't got enough people that are getting sick to find out if it works. So they're only going to find out if their vaccine works.
Breaking news. There's a chart up on the screen.
As if by magic. So they're only going to find out whether their vaccine works when they do travel and then they could be in trouble. So it's a bit weird.
Yeah.
So they could be the hermit kingdom locked down for far longer, and that's going to affect these guys. I can't get excited about this one, but if I had it, you've gone through the pain.
Yeah.
You know,
So that's a hold.
It's a hold at these levels, but you know, you need to be patient, I think, to see this one return.
Yeah, and hopefully haven't experienced too much in the losses, because sometimes you do know when to cut and run.
Yeah.
All right. Regional Express brings us to the halfway mark. REX is the ticker code, as many of you would well know. Ben, this one's for you. So look, there is no love lost, you've got to say, between Qantas, Alan Joyce, and Rex Airlines. Rex is trying to take the fight to Virgin and Qantas. It's got a couple of more jet aircrafts into its fleet. It wants to come out of the regions and really take on the capital city markets. But is it likely to happen?
I think it's very, very challenging. You know, we've seen those competition before. Look at Virgin trying to take on Qantas. Just given their size, given their balance sheet, they just won't be able to take on the fight. It won't last. It's definitely a sell for me.
It's a sell.
It's a sell. It's difficult.
And so you don't even look at this as sort of a reopening trade.
Look at you invest in Qantas. You know, the best airline, and now completely reopening. It's not even expensive. You know, it hasn't even gone to the all-time high yet. You know, so share price barely recovered from COVID. And then the domestic travel, when it returns, I don't know. I went to Gold Coast last week, and you know the flights were packed. So you know the holiday goers, and then it was not even school holidays. So you know, just domestic travel is going to contribute a significant amount of earnings for Qantas, even though we won't have international for another 12 months. I think that business is going to be quite profitable. So it's if you want to play reopen, you buy Qantas. Small airlines taking on a fight with a larger airline. It's historically hasn't ended very well.
It's going to end in tears. I was in tears emotionally when I booked my first ticket on an airplane since pre-COVID.
Have you been?
This week? No, I haven't gone yet. So end of the month.
Exciting.
But yeah, I
That's
just
exciting.
thought, wow, it's opening up.
It
and then
is.
of course, as soon as I pressed buy, I thought, oh, those state borders better not get shut down, because that is still the risk, isn't it? I mean, does a Victorian lockdown, again, it creates some enthusiasm about vaccination rates and everything else, but it also exposes our vulnerability still.
Well, it's the confidence factor. It's not just the vulnerability. It's the confidence factor that you get stuck somewhere. And you know, I've got a friend of ours that was in Byron, was flying back to Melbourne, and he can't get back to Melbourne, so now he's stuck in Sydney. And this is the problem, you get stuck somewhere. As far as Rex goes, it's definitely a no from me. These guys should stick to their knitting. Regional Express, that's what it says on the tin. It doesn't say Capital City Express. That would be CapEx, and that's what they would have to do and spend a lot on that, because to be honest, you know, you can fly to Melbourne for $30. How are you going to make money on that? You know, how are you going to take on Jetstar if that's with their fee structure? And you've got Virgin and Rex doing it. You know, Australia has not got the domestic tourism to support two airlines, especially as we now do driving holidays more, because, you know, who wants to risk getting locked into a major capital city when there's a lockdown? So you just drive in your own state, and everyone's, you know, you try and book places in regional Australia, and they're shockers. People, you know, we talk about the reopening trade. We're open. You know, there's no reopening. We are open. It's just Melbourne that isn't at the moment, and that will finish next week.
Okay,
But,
so
you
that
know,
is a sell if you've got Rex.
Definitely an avoid. Airlines are really hard at the best of times.
Absolutely.
Go with strength.
Exactly. And then the operating leverage is enormous.
Yeah.
We've seen it so many times.
And fuel prices are going up.
Yeah,
That's
yeah,
right.
yeah. Everything comes full circle on this program. Thinking of Centos, and that's sort of a good cue for me to do a little bit of a wrap up. Let our expert guests have a bit of a break. Stock of the day, the Reject Shop. Jun Bei says, look, this company should be doing better, all things considered. If you're looking for something in the retail space that also has still some leverage in terms of the reopening, look for Lavisa. So that's a bonus buy coming from Jun Bei. In terms of the Reject Shop for Henry, he says it's just in the too hard basket. Also, it doesn't have the digital exposure, and it's happening as we see these supply chain costs rising. So that is a no from him as well. NIB Holdings is a hold from both of our expert guests here, Jun Bei and Henry, but they're not overly excited about it. Jun Bei says that it's a bit exy as well, so a better value play if you're in that space, is Ramsay. So she says that will also, Ramsay, benefit from the higher adoption of private health insurance, but NIB is still a hold for her if you're in it. It's just fully priced. It's just not exciting for Henry, but it is still a hold from him. Santos, this one is going in the ausbiz portfolio. It is a buy from both of my expert guests today. And Henry says it's not too late. This is a company that has seen a lot of it hasn't fully priced in the recovery that we're seeing in the oil price, and he's quite bullish on the oil price going forward because of some of the discipline that we're seeing exhibited by OPEC Plus, and we saw it this week as well. Jun Bei points to many factors out of the commodities. Oil is looking like it's got the most upside from here, and she points to jet fuel demand as well and says that it's under-owned. That's why it's a buy. Duke Exploration, Jun Bei likes companies that are actually producing, and it's in the exploratory space. It's just not from her. It's a no. Oz Minerals, perhaps it's expensive, but it is producing. A Sandfire is a cheaper option in that space. It's a no from Henry as well. Look, it's 5 to 10 years away from even producing. There are better ways to look to make money out there in the market. Lucky. Bubs Australia, it is a hold for Henry, even though he has a real hate on for this company, obviously. And he's pointing again to the fact that there's no international travel. Jun Bei says that, look, it's still too early to be buying this one, but she does say that a lot of the bad news is priced in. And we briefly showed you a chart on screen, and you can see that evidence there. And that brings us to Rex. It is a avoid. It's a sell, in fact, for Jun Bei. If you want to buy an airline that has leverage to the reopening, why would you go anywhere other than Qantas? That is the one you need to invest in. It's so challenging out there for many different reasons, according to Henry. It needs to stick to its knitting. Why take on the big boys? It's a regional express. Stick to what the knitting is, and it's an avoid for him. So that brings us to the halfway mark. Let's get you across the ausbiz portfolio. We've got our portfolio that we've been tracking since the beginning of last July. Again, thanks to our partners at NAB Trade. Today, we've got Santos going in. All it takes is two of our expert guests to agree on a buy. Now, you think that would be easy. It doesn't happen all that often. So let's get a check on how we've been performing. We are up by close to 1% over the week. On the month, we're up by, just over 3%, so that's not bad. Year to date, we're up almost 33.26%. Part and parcel, and thanks to my guests here. If you guys want to weigh in on any of these ones that have been added lately, feel free. Bega Cheese, that was just yesterday, actually. It secured the rights to the branding of peanut butter from Kraft. It's in many a pantry around this nation, no doubt. Nine Entertainment, I guess in the wake especially of that Facebook Google deal. Do you like media?
Yeah, traditional media at the moment is actually looking really good.
Yeah,
because everyone is spending on advertising, branding, because reopening and all of that. So it's looking very strong.
Murray Cod, which I don't know really anything about, but I think it might say what it is on the tin. We'll look into that one. Beta Shares, S&P 500 Equal Weight ETF, another ETF, the VanEck Vectors, MSCI World, Australia, ex-Australia, I should say, Quality ETF went in recently. That's perhaps from our ETF special that we did a little bit earlier in the week. If you'd like to watch that, just go online. It's up and running. If you're a podcast listener as well, you might want to go back and listen to that one as well. You can get all of those companies, the full portfolio, on our website, ausbiz.co/portfolio. It's on your screen there. Again, thanks to NAB Trade. Well, shall we continue on then? Let's get to the next company on the list, Aussie Broadband, ABB. This is for Philip. I just had a conversation with one of our guests. You guys both know Gaurav Sodhi from Intelligent Investor. He loves this company. If you'd like to listen to that interview with Gaurav, it's up online as we speak. What do you think of Aussie Broadband?
This is funky. See, we're on funky again. So this is funky. This company actually gets really good customer feedback. It's had 2 upgrades from its prospectus forecast. It's only recently listed, and it seems to be pulling all the right strings at the moment. They're doing everything right. The markets like this story, and it has really kind of, everyone hates Telstra because their customer service, etc. Whereas these guys get massive ticks. When you actually, if you put on Facebook, which provider should I go for, the number of people that say go with ABB, Aussie Broadband, because they're really cool and they got good customer service and they look after you, it's a big tick in the box.
Okay, so that's all well and good, but Jun Bei, what do you think, in terms of the price or in terms of buy signals? I mean, do you like this?
I think it's probably more of a hold. Look, it's a good company. It's a resale NBN, and currently only have 4% market share. And like we talked about before, it's it's a good quality and the consumer likes it and all that. So, but the key issue is that once everyone has shifted to NBN, that growth will slow down, because right now everyone's just moving to NBN. So there's a heightened number of people actually joining the space. So the growth is really high. But once that's done in the next year or 2 years' time, what next? Then it becomes more trickier, because you have to gain market share, have to invest in all of that. But right now things look pretty good. It's expensive, so it's on the growth multiple. So you kind of need to keep that growth keep going, and then then it comes down to a problem in 2 years. What does it look like? What does a growth path look like? Mm-hmm. Does it become a slightly mature telco, or does it go to the next level and become much larger and become something else? So it's a hold in my mind. It's not exactly cheap. It's quite expensive, and it just needs that slightly longer term growth to come through.
And was that a hold for you, or was it a buy?
I'd go with a buy.
Yeah.
They're pushing into business, and I think that's the big. I mean, most people are probably in Australia on NBN of some sort of fashion, and there's a bit of churn goes on, and there's all that sort of stuff. But they're pushing through business, and this has got gearing effectively to the economy as well. As they roll out their fibre, which is about a year away, business will come on, and if they continue to be funky, people will like them, and they will draw fire. So. For me, it's a buy.
I like that funky factor.
Yeah,
funky always like a box. You got a ticket, funky factor.
Wow.
Hodl. I'm working through some translations. Diamond hands, and then we've got funky, which just does still sound a bit boomerish. No offense, but okay. So there's a bit of disagreement there. Buy, hold. Let's get to the next company on the list, which is Infomedia. This one is for Joe, IFM. Hey Joe, if you're listening or watching out there. So it designs, implements, manages consumer-facing e-commerce programs for OEMs. Also. Helping to increase sales of genuine OEM parts, accessories, and service. So in plain English, Henry, what does this company do? Why is it attractive?
Digital parts catalogues, basically, and the supply chain around car parts.
Yep.
It's just made a US acquisition.
It did.
Which...
Simple Part, I think it's called.
Simple Parts, yeah.
But it's software as a SaaS, essentially.
Yeah. So these guys provide all the back end for the parts and service departments to be able to order their parts, find out which little bit of screws and nuts and things that they need.
And we know that used car sales are going bananas.
We do, they are going bananas. So my concern, I guess, is that it needs to bed down the US acquisition, because I would imagine it's quite hard to do an overseas acquisition when you can't actually go there. And there are some risks around that. If you're just doing an acquisition by Zoom and looking at the books, it's sometimes kind of hard to see the whites of their eyes. So for me, it's pretty much a hold. And I think as time goes by and people get comfortable with the acquisition and it gets bedded down, then I think it becomes a buy. But at the moment, it's always tough. Companies that go and acquire, you've got to integrate egos, cultures, people. It's not always easy. Even if it's called Simple Parts, it's not a simple part of the business. It's a hard thing to get right, and many companies have come unstuck making US acquisitions, and it's even harder if you're doing it by Zoom or by Skype or whatever, and it worries me slightly.
So it's a hold.
It's a hold.
Fair enough. IFM, what do you think of the company?
It probably sits in that hold. So whole space as well. It is certainly the value part of the tech industry. It is very cheap, but clearly because they're directly linked to the car parts, and the shortages and disruptions in the supply chain for the car industry has created a lot of problem for this company. And now they did raise money at the peak of COVID period, and finally it's good. It's been weighing on the share price because they couldn't deploy it, and finally they bought this. It's in the US. Perhaps it would take some time for people to really get used to, whether you could do it, whether you can execute, and whether that's really a great business. So it just means that the company will probably stuck at where it is until people get clarity, and also when the car industry, the supply disruption gets a bit better. Now, from all the feedback, that it's probably not going to get better for the next 12 months. So it's still going to be in a pretty tough space.
Yeah, because the chart really isn't that impressive unless you're thinking about this as sort of a value tech name, but you're not.
Honestly, if you want to invest in tech, you buy tech. You don't buy value tech.
Yeah.
It's just, but that's the whole point of buying tech is growth.
Yeah. Yeah, good one. Okay. Envirosuite is the next one on the list. EVS. This is one of those companies that's often coming out with announcements and updates. It is, it's in maybe the right sort of area of the industry if all the ESG considerations are being taken on board. It's recently done a $14 million equity raising. It too wants to expand into new markets, that being North America primarily. What do you think of EVS, if anything?
It sounds like it's in the perfect right place. There's so much capital and institutional money being pouring into that environmentally friendly investment, and it's in the right place. Looks like it's on the right path, but look, it's early for me. It's early stage for me, but certainly it will trade well with the sentiments. Yes, it's still very early stage for me, but it's in the right place.
Yeah. So apparently the technology used across 190 sites within mining and industry, waste and wastewater sectors. It's all about reutilizing that water.
Yes.
It's not the only one, and there's a long way to go, isn't there?
Yeah, this stock has been on the slide it's been on a water slide. It's been out at Wet and Wild on a water slide for a long time, and it's in all the right spots. It's environmental intelligence, so it gives you intelligence about airports, about mining sites, about waste management, water management, all this sort of stuff. But it has gone absolutely just down the plug hole to some extent. Now, the good news is that it's done an equity raising. I don't know why it picked the bottom of the market to do that, but it's doing an equity raising which finishes, the retail offer closes next week on Friday, week today. So that may clear the air. That was 8.5 cents. They're currently 9.8. So that may kind of clear the air a little bit, and we may see some pickup in this one. If you owned it, I'd be a holder. I'd like to see a little bit of evidence that they're kind of the share price is turning the corner. All the businesses sound really cool, and you look through the presentation and they do a fantastic job. 3D this, it's funky. It is funky. That's the word of the day. It is funky, but they have failed to deliver big time, and the share price just basically halved. So,
well, if you fail to deliver and you're looking at that share price, if you're in it, why would you hold it? Like, what would be the catalyst to turn it around?
Because I think because the capital, they've done the capital raising, so at least they've got cash now. So they've done the capital raising. When the retail offer closes in a week's time, that will take some of the pressure off the stock to some extent. It's not the biggest stock in the world. So I think that could, you could see them bounce back towards 12, 13 cents for a quick, easy bounce in the next few months. So it's certainly more a buy than a sell. But if I had it, I'd hold it. If I was looking for something to buy as a punt, then maybe this one fills.
Okay, I'm not going to call it a buy though. No.
Don't call it a buy.
This is actually a fantastic example of why investor has to be very careful with thematic investing.
Yes.
You pick something out of a great theme, right place and everything, and the company come up with those fancy presentation and put every word that's highly sought after words in there. Yeah, exactly, in there, and then it just still needs execution, even though they're in the right place. And that's incredible. So for this kind of stock, I agree with you. They will trade with sentiment. Yep. Currently there's bad news, things didn't work. But when you want to buy those sort of stock, you need to time yourself, because just make sure you're not there when there's an earnings announcement, because a lot of time they will disappoint. And if you look at the share price, how it reacts, it seems to be every result kind of falls off. So when execution is difficult, you can buy when there's a raising, and perhaps with sentiment you'll trade a little bit, but then you just need to be there to take profits. Yep. It's just thematic investing is full of danger.
Okay.
Yep.
This is completely separate from Envirosuite, but it has reminded me, an example of this sort of sentiment-driven stuff is that this week we had Robin Dunham from Tesla talking about buying up of Australian lithium assets. And I don't know if you guys noticed it, but all of a sudden the next day, there was all these announcements coming from little lithium companies, right? It happens. And I do note that under the compliance update that's been put out by the ASX, so the market regulator, ASX, it's actually put out an updated section on ramping announcements. So it acknowledges that ASX is alive to listed entities making market announcements with a view to ramping up their price of securities, and it provides examples. So it outlines what it will do if it detects what it suspects to be a ramping announcement, including giving careful consideration to suspending the entity's securities. So basically it's saying that, a lot of those companies that come out just to ride some sort of a narrative out there, thematic, that they are alive to it. And I think that it goes back to our original discussion about meme stocks. You've got to have these regulators sort of alive to this fact that there are these pushes happening across the market. Nothing new. But what do you make of that development?
Yeah, look, I think that's interesting. Absolutely. We see, ultimately who gets impacted are those retail investors, right? So, impacted as in, it's the retail investors that not knowing what's happening, and then, share price goes up, and then you chase and all of that, you get involved. So it's very important for, transparency and, more clarity. So that helps the retail investors to be able to really see what's going behind the scene, rather than it's hot.
Yeah, because you've got to take some of these price sensitive announcements with a grain of salt, right?
I've got to say, some of these retail investors are making off like bandits. We keep trying to protect them. These guys are making a fortune out of AMC.
All right, nanny state.
And you look all over hot copper and all this sort of stuff. These guys, they've got their own thing going on here that we in Insto land or in professional land just go, you're idiots. You know what? Maybe we're the idiots. Maybe we are the idiots.
No. We manage on a risk-adjusted return.
Yeah.
But certainly some of the experiences I've had emailed to me by, because I do small cap stuff, by our members, would suggest that sometimes.
Yeah, right. All right. Well, you heard it here first, people. Henry Jennings looking in the mirror. Okay, Objective Corporation, OCL, is coming to us from William. Again, SaaS. This is a company, Jun Bei, that's had a huge share price run. It's not sexy necessarily in what it does, because it helps government institutions essentially move from paper onto digital content. So this is a company, one of those ones that recurring revenue is very important. Do you like it?
Yeah, I should do. It's a small company. It's a very high quality SaaS business, and it got large contracts, very stable contracts. And the only thing is that the CEO owns 66% of the company, and he keeps using extra cash to buy back shares. So the free flow keeps going lower and lower. Obviously he has a very high confidence in what he can deliver, and it's a very high quality business. So if you can get your hands on some shares, I think it's pretty strong.
So that's
it's
a buy
for me.
I'd have to say the same, but 66% owned by Tony Walls. It's I don't know why it's listed, to be honest. At the end of the day, I don't know why it's listed. He's buying back the shares. It trades 5,000 or 10,000 shares a day. It moves big time. If you're an institution, one of the dummies that I'm now saying, that wanted to buy 100,000 shares, good luck.
Yeah. Okay.
That's the trouble. So it's been a good quality, great story, but just really hard to get set. It should be private. 66% owned by one guy.
Yeah. So it's already in the call portfolio.
Okay. Well, it's definitely a buy.
Okay, so it's remaining in there. I didn't want to lead you, but if you would have said sell, it would have been coming out.
There's no reason to sell it.
Okay.
If he's buying it, why sell it?
Yeah, right.
Ultimate insider.
Yeah.
That's right.
I mean, that's what we always talk about. You like seeing people with skin in the game. The only problem is it's impacting liquidity, and it's hard to get your hands on it. GPT Group is the last one. I think it's a good way to end, because it does throw up some of the narratives that we've been talking about. I mean, potentially impacted by lockdowns in Victoria, further lockdowns if they do happen, but also, could be leveraged to the upside as we see this recovery in the economy.
Absolutely. I think GPT is a buy. It's probably more of a weak buy, because I'm going to talk about another one which is more exciting.
Gosh, we're turning Jun Bei into these. Yeah,
there's another good one. So yes, it's reopening, and it's got big office exposure as well. So offices, if you look at Dexter's and everything, has done quite well, and this one gives that good quality office exposure, and retail looks pretty good, and it's not expensive. So on that basis, it should it should do okay. Now, relative to that one, my view is that I much prefer to be in the malls. So Centre Group,
Really?
for example, Centre Group. So Vicinity is very much skewed to Victorian things. Centre Group is just high quality, much high quality, and it's much cheaper compared to its the asset it holds. These are the Westfields and the like. Really central location. For malls to trade that kind of discount is just very unusual. And globally, we actually see with the reopening, on track, that globally more or started having a good run. And I think these guys have a lot more room to move. Now, there's another concern at the moment that people worry about inflation. So, a lot of time when the inflation starts to move, the overall people look for inflation hedge. What companies can pass on the high inflation? So Centre Group is the highest exposure to inflation escalator in their portfolio amongst the whole listed REITs, because they got 80% of their portfolio, or more than 80% of their portfolio has direct inflation rises. So inflation goes up 2%, they will go back to their rent it's going up 2% plus the rent. So it's actually very well cushioned, and it's very clear in all the documentation. So there's no guessing on whether you can pass it on. It's like it's in.
It's in the
so it's actually a really good inflation hedge on that basis. Plus your earnings going to grow quite meaningfully in the next 2 years. So
great.
That's a stronger buy.
Jun Bei's been very generous with her buys as well, her bonus buys.
Have I been stingy?
Well, no. Not any more than normal. JPT Group is the question, though, from Jane. Would you be buying GPT? To Jun Bei's point, it's got office exposure, does have retail exposure. I believe it also has a bit of industrial as well. It's got a bit of a mix.
Well, it's called the General Property Trust for a reason.
Well, good one.
It's got that mix, that broad diversification, which is fantastic. They've also got a lot of back rent that they should be collecting, which is going to help distributions going forward. I mean, REITs don't really, unless there's a cataclysmic event like we saw last March where the market just tanked and then you get the big bounce again as we reopen or the economy bounces back. They don't really do a huge amount, apart from Goodman Group, which just does that. This is a weak buy for me as well. I prefer Goodman Group, I've got to say, because of that logistics and the warehousing, and it's more specialised. And Centre Group, as Jun Bei says, is another good one to buy. And Mirvac.
Okay.
Just as,
now he's really coming to the party with his buy. Overcompensating, Henry.
I was feeling I was being stingy.
But that's true, though. Yeah. I agree. I think Mirvac's
interesting. Residential exposure.
Exactly.
All right. I'm just communicating with Gautam, my producer. Do we give this week buy in GPT? Put it in the portfolio. Yep, it's going in. All right. That's the word. It's very high tech, isn't it?
Very high tech.
It's very movie set. Okay. Let's just quickly run you through these past 5 companies. Aussie Broadband, it is a buy for Henry Jennings. It's one of his funky bunch today. It's a hold, though, for Jun Bei. She says, look, it looks expensive if you consider that it's priced for growth. Where's that growth going to come from past this initial phase? What's next is the question for her. Infomedia, it's a hold for Jun Bei. Again, you need clarity when it comes to that U.S. acquisition. Also, supply chain. Think about the shortages and how it's impacting the company, and that might go on for the next 12 months or so. It's a hold for Henry as well because, again, of that uncertainty around that U.S. acquisition. He doesn't reckon you can see the whites of your eyes when you're doing this stuff by Zoom. Envirosuite, again, Jun Bei says be careful when you're talking about these thematics. Everything can sound well and good, but you actually have to know whether or not it's a sentiment play. Look at the fundamentals. For her, this is just too early stage. It's an avoid. It's a hold for Henry. The share price has been doing nothing, but it does have a share purchase plan on the table, so this could be a potential trading stock for him. So it's just a hold. Objective Corporation, it's a buy for Jun Bei. She says very high quality, very stable contracts. 66% owned by the CEO, so that's a bit of an issue, but she still says that it's a good company. Henry says if you own it, absolutely no reason to sell it, but he does question why it's even listed, again, because of that really tight ownership structure. GPT Group, it is a weak buy from both of my expert guests, Jun Bei Liu from Tribeca and Henry Jennings from Marcus Today. It is going into the ausbiz portfolio. Jun Bei says that she would prefer to buy Centre Group, and I think it's an interesting one. I haven't heard this sort of fleshed out before, to be honest. It's high quality, it's cheaper, but it can also pass on inflation. If we're worried about inflation, it's actually in its contracts that it will get paid more as inflation grows by its tenant. So that's a good one there. Not to be outdone, Henry says he likes Goodman Group. He would also buy Mirvac, but Jun Bei says she would buy Mirvac too, so you are spoiled for choice in the property space today. Guys, that was a lot of fun. It's a Friday. Why not, right? Jun Bei Liu, Tribeca, always enjoy the conversation. You too, Henry Jennings from Markets Today. Hope you guys have a great weekend. Hope you have a good weekend, and don't forget you can check up on that portfolio via our website. You can also email us at thecall@ausbiz.com.au. Stay with us, though. We've got plenty more market analysis coming right up.
After a period of bleakness, this is a show about the light ahead. A unique Chinese and Australian co-production exploring the opportunities in both countries after the pandemic.
Hello， 大家好，我是来自澳大利亚的 Amy。
Everything works differently in China.
You build relationships in China around trust and respect.
We have an unprecedented number of trade agreements.
Our relationship with China is fundamental to Fortescue's success.
Now is the time for business to step through the door.
The business of business between Australia and China is my passion. And whilst there are obvious political tensions now, opportunity awaits.
If you're sitting in China, you look around the world, it would be hard to find a country that is easier to invest in or export to than Australia.